So here we go, right?
Yeah,
lots of changes going on. I mean, when I got in the mortgage business, I worked for this guy, great guy, and he said that, the mortgage business, about 90% of it, 95% of it, it's the same every year. But there's always this little bit that's changing. Right now, we have a pretty large, a bunch of ideas that are coming in, whether it's 50-year mortgages, this idea of portable mortgages.
Let's talk about why these ideas are coming up. It's because they feel there's an affordability issue, right? It's that but people are not able to get into a home right now because prices are high. And with the rates the way they are, the payments are too high. Is that what we're looking at?
I mean, I think to a degree, there's always going to be a percentage of the people that are interested in owning their own home for good reason, and we're going to dive into that, I'm sure. But there's also people that budgetarily, they just don't have the foresight to see, hey, look, this payment or my housing expense, if I'm going to rent, is this much.
Right.
But by owning, that payment's going to go up to this, and I just don't see the value, or I don't see down the road.
Right.
The difference with this is nothing stays the same. I mean, houses continue to go. I mean, you could tell I got gray in my beard. Houses, my parents moved here 50 years ago and bought a house for $20,000.
Yeah.
Yeah. So, and the idea is that if you think rent's going to be the same 5 or 10 or 15 years from now, that's really the idea. It's like they're talking about affordability or rent control in some areas of the country right now.
Yeah.
I mean, there's no better rent control than owning, having a fixed
payment.
A fixed payment,
Yeah.
whether it's, a 10-year or a 15-year.
That's never going to change.
Or never going to change. 30 or even a 50-year mortgage, which they're proposing now. I'd like to see them, open this up where, why not go 35, 40, 45, 50, and let the consumers decide as to
what they want.
Yeah, budgetarily, and see if it makes sense. I mean, the idea that, that you're not gonna that somehow we're gonna get people out of the housing. Like the people that bought houses 5 years ago, that their house is worth $400,000 or $500,000 more. I don't think they're going to care whether they were in a 30 or a 50-year mortgage.
Right.
And people that are excluded from that because they don't qualify for a 30 or they don't like that monthly payment at a 30, well, maybe at a 40-year mortgage they do. It's more comfortable for them. So why would we, if we're exploring these options to create some more mobility in the market and more affordability, just like the portable stuff.
And the key thing before we jump into the portable thing is the key word there is option. Like you said, these are just options. This is not replacing the 30-year. From the lender standpoint, though, I'm hearing that the lenders are having a tough time, agreeing, or they're going to have a tough time agreeing to something like this because from their standpoint, the risk for them up front, the first 5-10 years, is great. It's massive.
Well, it's just like anything else, right? When you're talking about risk, we're talking about rate of return, right? So the spread between what a 30-year loan would be versus a 35 or a 40, it's the same thing.
Right.
If you get a 20-year loan versus a 30, that rate of return is less.
Right.
So it's less risk, right? So there's always a way to, what that spread would be. I have no idea because what we're talking about is kind of all hypothetical.
Mm-hmm.
But, looking at numbers on that, there's all kinds of different ways to look at things. And I have friends and people that, they got a 3% mortgage and they're in a hurry to pay off their home.
Mm-hmm.
It's just, to me, it just doesn't make a ton of sense. If you're paying 3% interest on a mortgage and you can get 4.5% on a very safe investment, why would you send that extra money to your mortgage?
Yeah.
Other thing that people don't think about, if you took out I'm throwing some rough numbers out here, like somebody's buying a $650,000 house, putting down 5%, the difference between that monthly payment on a 50 versus a 30 is probably like, let's just say it's around $300 a month.
Right.
Well, instead of sending that money, instead of doing the 30 and paying $300 more a month, let's say you took that $300 a month and you put it into like S&P index fund that's average
every month,
every month, average 10%. In 30 years, you're going to have enough money to pay off that mortgage anyway.
Yeah.
So it's just, there's lots of different ways to go about, doing this. And that's where, having a consultation with somebody, that's everybody's plan and everybody's idea of what their future wants to look like is different, and we can customize those.
Yeah,
You know, say, hey, look, you know, and the other thing is flexibility. People that are on a 30-year mortgage, why it's great is because you can, if you choose to, pay more towards your mortgage. You can. And then all of a sudden, maybe there's a life circumstances. Maybe you have an addition to the family, and there's additional expenses. You can go back to that 30-year payment. But
Yep.
if you're pigeonholed into making a certain amount, you know, a certain monthly payment, and all of a sudden that's, you know, it just
That
offers
gets
more
tight, yeah.
flexibility. So yeah, you're paying more interest, but you know, to a degree, these things should be customizable for people,
Yeah.
so it fits their situation. And given that,
And that's what that would do, right? Like, because I think there are some places that already offer the 40-year, right? Not everywhere, but some places do offer the 40. So if you have a 10, 15, 30, 40, 50, those are all options.
Yeah.
Those are all options on the table for you. You could just look at it and let's say even if you qualified at the 50, like you said, if you qualified at the 30, you still might want to take a 50 just because things may be a little tight. And then, you know, pay extra and have the option of paying that down yourself rather than have to do it.
Yeah, and
right?
if you choose to, because there's people that, you know, they're not as big a fan of housing. I mean, unless you're able to, and I don't know, unless you're able to live at home and not have a housing expense, you're going to be paying for housing anyway.
No matter what.
Yeah.
No
And
matter
so,
what.
Yeah, so it's
Yeah.
just, it's a question of what fits, right? So these options give us the ability to fit more people into homes, and I think we all know that people own their homes over extended period of their life are wealthier than people that don't. I mean, the numbers
they all
don't.
are.
The numbers don't.
The
lie.
numbers don't lie, and they're massive. The difference between retirement, if you've ever bought a home, and what your net worth is at retirement, is something like over $400,000, and if you never bought, your net worth is under $12,000. I mean, there's a massive
huge.
difference.
It's
a
huge.
massive
It's
difference.
huge. And here's the other thing: like people will some people are really big on the stock market. You know, maybe the last couple of days they're not because of the pullback. But you know, if you want to buy, you know, if let's say you got a 50 grand and you want to put it into Tesla stock and that stock grows at whatever percent, you know, you need that 50 grand, right? But if you want to buy, you know, a $500,000 house, you put down 5%, 25 grand. If that house appreciates at 4%, it's that leverage. You're leveraging that money for that down. Now, granted, you're making a house payment,
Yeah.
but you'd be making a rent payment anyway.
You will be making a rent
You're
payment
making-
anyhow.
yeah.
And not only that, but your rent payment will likely go up over time.
Not likely.
Not likely. It will go up
Yeah.
over time.
If you think these guys that rent you your properties, if their taxes go up, and that's another thing, right? We can talk about like, when do you ever get a notice that your taxes are going down from whatever county?
Yeah.
It doesn't
I've
happen.
never gotten one.
So when those taxes go up, they're transferring that to the people who
That's
are
part of
renting.
the reason why the rents go up is because the inflation
Sure.
and expenses go up for the owners. Yeah, and so they pass that cost onto the consumer.
Absolutely. Yeah. So
And if you own a home, you don't have to worry about that. Now, you do have to worry about the taxes going up, and then you have to adjust. But that's
But the taxes go up because the values go up.
Go up,
And if
exactly.
the values go up, you benefit
assessment.
from that. Yeah,
Exactly.
Yeah, you benefit from that. So if you want to turn around and sell your property, you're going to make money from it, right? So it's just, you know, I met with a guy last night. He bought a house. I think this was during COVID, 2020, was 5 years ago, right? He bought a house. I think it was $500,000 or $600,000. And we were just talking. I hadn't seen this guy in a while, and just catching up. Great guy. And I'm like, hey man, how much is your? I mean, I should know, but I'm like, how much is your house worth now? He's like, I think it's worth like $850,000, $900,000. 5 years, this house has gone up $300,000 or $400,000.
Yeah.
And that's not going to happen every 5 year
No,
period.
because
but-
he bought, during the pandemic era.
Right. But the same thing had kind of happened in the early 2000s to a degree.
Yeah.
I mean, it happens.
It happens all the time.
Yeah.
I mean, not to that extent, but it does happen where the value of your home just goes up.
Right,
I
right.
mean, a house in 1990. One of the biggest regrets that I think in my own family, again, my parents, not that it was anything to do with my parents or anything, but my parents came here and they actually tried to buy a house in the early 90s, didn't get to do it. So if you think about what the net worth of my father will be today versus what it is, it's massively different. Like if he was going to buy a home in Fairfax in early 1990, in
250, 200,
he would have paid a couple $100,000 for it, and today what, $1 million?
Yeah.
You know, and he would have been paid off,
right?
Because 92 to today is over 30 years.
Paid off is one thing, right? And but it's like the guy that I was talking about here. Do you think, like, we're spitballing about maybe having a 50-year mortgage or a 40-year mortgage or whatever? You know, do you think he would have cared? He made $300,000 or $400,000 on this property he bought 5 years ago. Think he's going to care if it was a 50-year mortgage or a 30-year mortgage?
No, he wouldn't care.
Yeah. So it's just, if you're not in that game, you don't have the opportunity. Just like if you're not in the stock market, you know what I mean. If you don't own things, and that's wealthy people.
Yeah.
They own things.
They own
things.
assets.
They own assets. Yeah.
Appreciating assets.
Not cars.
No, appreciating assets. So that's the name of the game. Own appreciating assets.
Right.
So if you don't own appreciating assets, then you're always spending.
Yeah, and a friend of my wife's family, who was actually in the mortgage business for a while, told me that, and this is not a slight on anybody, but like, most people think about what they're going to do on Friday night, and wealthy people think about what their plan is for generations.
Yeah.
You know what I mean?
Yeah.
So it's that long-term vision, realizing that, you know, nothing stays the same, right? And to a degree, and there can always be moments in time where things, I mean, I don't think property values are going to be going down anytime soon.
No.
But could there be a little bit of
there be a dip? There could be, but over time.
Yeah. I mean,
what are we talking about?
Yeah, look at the stock market.
I mean, and by the way, I'm a massive fan of the stock market. Right? I think it's. I mean, if you're not investing, if you don't have a portfolio, if you're not investing in the stock market, you're making a massive mistake. That this isn't to say just invest in real estate and forget about the stock market. Do both.
Right. Well, I think there's a kind of thing now where, like, a lot of the financial stuff has kind of moved away. Like, there used to be, I remember, like, in the 80s, my dad was a school teacher. You have a pension. A lot of the pension stuff, for the most part, is kind of going away, and they have, like, a 401k. So investing in a 401k, you know, whatever type of match, at least getting a match from your employer. But I think it's important to not just, like, if you had a choice between owning your own home and sending that money to the stock market, I think you're locking in that control of your future.
Right.
Because really, you're just giving away you're giving those controls. You know, I'm not a video game guy, but my kids are. You're giving away that control to somebody else to make those decisions.
Right,
housing is one of the, most important things you can have.
Yeah.
Control over. So.
Yeah. And then freezing that payment, which we talked about, I mean, we haven't even touched on the fact that how much money if you do the calculation of buying today versus renting today, and then take a look at that and fast forward 10, 15 years, what that rent will look like versus you staying flat with your mortgage.
I do those scenarios all the time, a rent versus own scenario, and I do the rent like at 1 or 2%.
Right.
You know what I mean? And then it's still the
even if you go under what the projected increase is going to be, you're still
coming out
screwed.
Way ahead. Way ahead.
Yeah, way ahead if you buy. Yeah. Way ahead.
And it's because you're basically your initial investment for most people on a home, the average down payment is roughly 6%, 7% the average down payment.
Right.
I mean, there's loans that people can qualify for putting down no money.
Right.
But your appreciation isn't on that 6 or 7% down payment. It's on the total value of the property. Yeah. So it's just, it's like being able to buy, $400,000 worth of stock for $20,000.
For 20, exactly. Yeah. And so all of that, we went over all of that just to say, 50-year mortgage. Again, this isn't something that is active now. This isn't something that is being offered, but it's something that is being talked about. I'm for it just simply because it's an option. It's not going to replace the 30-year mortgage. It's going to be another option. You do not have to go that route. And I do understand people's concern that if that becomes an option, then that becomes the norm. Like that most people are going to choose that option because it's a cheaper option, not understanding or being fully aware that they're not paying enough towards, or that they're paying so much more interest on the property. As long as that is all being completely disclosed to the consumer.
Right.
Okay, and maybe, one of the guardrails is to show both options to the client every single time, at 30 and a 50, side by side, so that they can see, how much you would pay in interest if you go the full on 50 and the full on 30. And that way they have that understanding. I'm all for transparency, right? But I'm also all for options.
Yeah,
giving the consumer options.
I think the options thing is really the key word. And just so people, for transparency's sake, people that do what I do are loan officers to help people that educate people on mortgages and hey, what's your budget? Where do you want to be? How's this going to work? And being able to customize that. We don't get paid any more or any less. We get paid based off of whatever that loan amount is.
Right.
So wouldn't expect this to change if that came into fruition. So if you had a 50-year or a 35-year or a 25-year, it doesn't change anything.
Yeah.
These are just the things that, and a good loan officer is going to show you, hey, this is the proposal. And I've been doing this for about 10 years, and I can probably count on one hand the number of 15-year mortgages I've done, which is shorter term. It's just, especially now, those monthly payments, people are always looking at this. It's just not that feasible for people.
Right.
But maybe a 25-year is. The option, or maybe it's a 40. So it's just another, like Jose said, it's just another option.
It's another option. Yeah, it's another option. And it's great to have option that to give the consumer. I think for the longest time, the 15-year has been there, but I don't think people feel like that's an option for them.
I love
because it's so high, right? So they feel like the only option they have is a 30-year, or if not, then an ARM. Right. If you want the lower payment, then it's an adjustable rate mortgage.
It's risky,
which is riskier, right? I'd rather you do a 50 than an adjustable rate mortgage.
Well, and that's where, again, you'd rather, but it's a thing is where it's individual.
It's an option,
it's a different option.
It's an option,
and it's the kind of thing too.
It's the point.
The ones on the 15-year mortgages that I've done, I'm pretty sure that almost all those people had called me back in a couple of years, and we went back to a 30. Just because it doesn't allow the flexibility that these other ones do. And flexibility in life with not knowing what's coming, is a good thing. So then that's the 50-year. The other thing being floated around is the portable, mortgage, right? Right.
And what say you?
Anything that allows people to create some more mobility in the market. The problem that we have is not that people don't want to own their home.
Right.
It's that people don't want to sell their home.
Right.
Right. And so.
Well, they don't want to. It's not that they don't want to sell their home. It's that they don't want to sell their home with that rate.
Right.
But they might want to sell their home, but they
but that would the idea that's being proposed that you're going to be able to, if you have a 3% interest rate, there's problems with this. If you have a 3% interest rate and you want to downsize or you want to buy a different home, that you'll be able to take that 3% mortgage and move it to the new property. Now, there's you can see problems. I can see problems with this in the respect of if you're buying a home that's more expensive, that you're going to need to take out, unless you have the cash, you're going to need to take out a second mortgage.
Right.
It's just like the assumable aspect of mortgages, but it's going to take forever for them to implement this. The other thing is when these mortgages get bought and sold, the risk assessment is tied to that property.
Right.
So if you own a detached home and all of a sudden maybe it's an older family and the kids have moved out and they want to downsize into like a condo.
Right.
We know that condos are a riskier investment. While that same 3% mortgage that was based off a detached single-family home is not going to have the same...
The risk profile was based on that one particular property, yes.
Yeah, and all this is going to have to be...
worked out, again, it may not work. All of these, even if it does, it's going to have to be worked out pretty tightly. I'm assuming that the second loan that you're talking about, if let's say that your balance on that 3% is much lower than what you're borrowing to buy that step up home, they're going to have to be more lenient as to getting a second loan. But the problem with that part is, remember, recordation sequence, right?
Right.
So that second one would have to take second place behind the 3%. So that also becomes another problem. So there's all kinds of problems that are, in there that, people that are way smarter than me are going to have to think about how they put this together. But I mean, it got everybody excited. It got everybody talking about it. Can I take my 3% mortgage and I can move now and take my that rate? Heck yeah, I'm going to do it. But
it's definitely there's some hurdles to overcome with that. It can be done, looking at like assumable loans like FHA and VA. I mean, those are government backed. There's probably going to have to be some type of government intervention in the respect of how this is going to go. And I'm not sure how I really feel about that. The less the government's involved in what we do, I think the better off we're going to be. But that's just me personally. We're the government. We're here to help. So
and anytime it happens with FHA. Anytime that they try to do something, it just becomes a mess. But I don't think I do think that there might be a way. It's just I'm on a wait and see what they're throwing out, because they threw out the concept, right? The portable, take the mortgage. But the details behind it, it's going to be, I think we're going to see a lot of different layers to this. Like, this isn't going to be just you can take your mortgage. No, this is going to be layered in some form if it happens. If it happens at all. If they can even figure out a way. Because I'm very skeptical. I think that it's very likely that they go, no, we just can't do it. This is not a thing that we could pull off.
I think as many ideas as they have to create some mobility in the market and to kind of unlock what we have going on here. And everybody that's got a 2.5% or a 3% mortgage rate is very grateful, but that was probably a mistake, right?
Yeah,
I mean, So I if you look at this, I mean, I think an easier way to maybe do this, and I don't know how they would do it, would be to get rates in a range where it does create that mobility. Going from a 3% mortgage to a 7 or a 6.5. I mean, that's a lot of thing. But if you said, hey, we need to move, we got to do something. You get into a 4 to 5 or percent range of a mortgage. I mean, it's certainly a lot more feasible for that mobility to kind of go on and to not be in this kind of lockdown thing. So
I agree. But I do think that they're going to figure something out, and the main reason why is because the younger generations, especially the two behind the Gen Xers, the millennials and the Gen Z.
I got them in my house. Yeah, I know what you're talking about.
Those people are, those two generations are looking at home ownership as something that is just not attainable. And they're actually starting to be okay with not owning, which will turn them into renters long term if they don't see it as owning. So we, as a society, I think we got to figure out a way to make it so that they are able to participate in home ownership.
Absolutely. I got a couple in my house. And so I believe that's one of the first things that, I got a daughter that just graduated from college, and I got a son who's just getting ready to graduate. I mean, the very first thing we're going to do is put them in a position or help them get into a position, knowing what I know and what, owning a home since I was 24 years old has done for my family. Right. I'm going to make sure that I'm going to do whatever I have to put them
whatever I have to. Yeah,
because I know the way that this is going to go. It's going to continue to go the way it's going.
Absolutely.
Not at little moments in time. There's always a pullback. There's always a time, but you can't. It's just like trying to time the market. You can't.
Yep.
But long term, I mean, it's just not an option.
I'll do anything to make sure that my kids own.
Right.
This is how you know that we are not bullshitting here. We do whatever it is that we have to do to ensure. And we've been in this business decades, and we want to make sure that our family is. I want to make sure my entire family owns. My brother already owns. My sister owns. You just want to make sure that everybody in your family. This is how wealth is built. This is part of the way wealth is built in this country.
Yeah, I mean, there's lots of different things, but it's just like we were talking about the taking the savings from the monthly payment. If you went to a 50 versus a 30 and investing that, I mean, people that own businesses buy into a business or buy, get into the stock market, and it's just being diversified probably means not just renting a house,
right?
It means owning a house.
I mean, I think you start there, though. I mean, you got to start with owning a house because to me, it's the most basic thing. It's forced savings. Basically, you're being forced to save because your mortgage payment is going to your home.
Right.
To your asset.
And here's the thing. You got two guys on here that believe in what they're talking about. But if you don't believe us, look at what some of the largest institutions in our country are doing
right now.
They're buying up not just properties, individual. They're buying up entire neighborhoods so that they can control the cost of what people pay for housing.
Yeah.
And that's what we're talking about. Whether you call it renting or you call it owning, it's the cost of housing.
Exactly.
Why not control that on your own, as opposed to being dictated to you?
Exactly. No, I totally, I'm with you. I'm with you.
Well, okay. Good. I'm glad we agree on that.
No, and I'm glad that I've been dying to touch on these two subjects because it's recent, but it's also a couple of weeks in, and I've had time to think about it, and my first reaction was like, "What? We're gonna put people on a 50-year?" But then you start thinking about it, and then it all starts making sense. Then they talked about the portable mortgage, and I was like, how the heck is that going to work? Then you start thinking about it, and then you start thinking about the layers. Just like you, I started thinking about all these layers that could affect that strategy. And then I realized, you know what? I'm just going to have to let people that are above my level think about how they can put this together, because the idea as a concept is great. Take your rate with you. I just don't know if it can be executed, but I'm hoping that they can figure it out.
Yeah, I hope there's other options that come out.
Yeah, I do. I like that we're talking about it.
Yeah, I hope there's other options, and it's like the 50. I think that most people are not going to go, hey, all right, now we're at 50. I think now what this does is it's going to be more of a customized thing where you're going to look, hey, these are the options.
Right.
This is what we got going on here, and we're kind of tailoring the mortgage to what somebody's plans are, what their future is. You know what I mean?
Yeah.
And then, again, building in, if you can, when you're doing this, build in some flexibility, right?
Yeah.
Build in that flexibility because things do change, right?
Of course. Of course. Yeah. So let's, I'm glad that we touched on that, and we'll stay on top of it. We'll continue to talk about it as more come out. We'll keep having conversations about this and bringing actual news to people once some of this stuff breaks. What do you think about the Zillow lawsuit? Did you get a chance to
I've kind of dabbled.
look into that?
I listened to a podcast. I can't remember whose it was. It was awesome. I sent it out to a few of my friends in our business. Yeah.
I'm listening to it.
I think there's going to be a lot of people in trouble.
So, and not just Zillow. If people think it's just Zillow, it's not just Zillow.
It's
those agents.
The steering aspect of what went on in that is very, steering business.
RESPA.
It's just like, the whole RESPA thing. RESPA. But it's the kind of thing where I think most people I want people to use me because they want to use me.
Right.
Not because I have some leverage over them that's some kind of value that they're going. I want people to use me because they know I do a good job for their clients and I take care of them, right?
Yeah.
But that's not what that was about.
So here's where the difference is, right? So I'm a full believer in ecosystems, right? So I think that having a lender I trust, title company I trust, home inspector I trust, within my ecosystem benefits my client, right? But to steer people into those other services the way that they were doing it by incentivizing them that's
not trust. That's monetary gain.
That's monetary gain.
Right.
Exactly. So if you, unless you are able to separate those two things and say, you know what? To my client, I have a couple clients that say, "Oh, Jose," laughing. They're like, "You're my yellow pages," right? Because I have over the decades, I have put together trusted people around me that I can safely recommend to my clients, and that has become sort of my ecosystem, right? Where I say to people, you need somebody. If you have your own mortgage person, great. But if you need somebody, here, John, right?
Right.
You have a title company, great. Use your title company. But if you don't, JDM Title, use them. I know I can trust them, right? No monetary benefit from me. Just these are the people that I have worked with that I know are good at their job, that I know their service is going to benefit my client. This is not what went on at Zillow. This is Zillow making agents use Zillow Mortgage. Is it called Zillow Mortgage? Is that what it's called?
Yeah.
Zillow
Home Loans.
Zillow Home Loans. That's it. Zillow Home Loans. This is Zillow account executives at Zillow, because now Zillow as a company saying, well, those account executives were doing things that they weren't supposed to be doing. That's BS. I think that came from the top. But anyway, this is Zillow saying to the agents whom they were selling leads to. Leads are, by the way, you guys, people who are searching on Zillow, you become a lead anytime that you put in your phone number or your email. They were taking your information, they were selling it to an agent, and they were saying, I'm going to continue to give you, what? Go ahead.
It's so amazing to me that there's lots of people that are so unaware of what you just said.
Yeah.
They just think they're
They think they're contacting the agent, the listing agent.
Yeah, but they think they're just, doing some searching. They are collecting all this data.
All the data, yeah.
Yeah, all this data, and they're going to be,
to sell it.
To sell it, yeah, absolutely.
And then they sell, so that's how it works. It works exactly like that. They'll take the data, they sell it to the agent, and then the agent is supposed to service that client. So what Zillow's directive was to these agents was, I'm going to give you more lead and better quality. What they call quality lead means that the borrower or the buyer is closer to buying, right? So those become more quality versus people. They know they have these layers where they know that a buyer is almost ready to buy versus somebody who's just browsing, right? They have their algorithms and things like that. So they were like, if you send these clients if you steer, I'm going to use the word steer, even though it's a bad word in real estate. If you steer these clients to Zillow Home Loans, I'm going to give you better leads and more leads.
Yeah, and there was a percentage to that, wasn't there? If the Zillow Home Loans wasn't closing, I don't know. I shouldn't even probably be saying this, but if it wasn't more than like 50% of the leads, that they were going to reduce the number of leads they were going to be receiving.
Exactly. So they were punishing you if you were not steering. So, but here's the thing. This is why Zillow is being sued. The issue also, another issue is the agents who actually took that direction and actually did what Zillow asked them to do.
It's a violation.
It's a violation.
Yeah.
It's not just a violation of RESPA, but you're also violating your fiduciary duty to your client. Like, that's one of the most sacred things that we as agents have. You just, you remember that class and, the fiduciary duties that we talked about.
Right.
You are basically entrusted by your client. They're supposed to trust you fully. And you turned around and you said, I am just going to make you use this, force you to use this loan company.
It's so disturbing. There's so many good people in our industry that they know, hey, they're following the rules. They're doing it. I can't do that. They can't do that because they're violating their ethics. They're violating these things. But then you have these big companies where it's all about money. They're gonna push these people to break. And don't get me wrong, you should know your job. You should know that's a problem.
Yeah.
And that you could get in a lot of trouble for it. Right?
Yeah. As an agent, you have to know that. You have got to know that. And this is coming from somebody who, by the way, I have never really been a Zillow hater. Like I felt like they do sell people's data and they're not clear about, what, because one of the bigger complaints is that when people are searching in Zillow and they see a home they like and it says contact me, they think most people or a lot of people, I don't know if most people at this point because it's so out there now, but I'm still sure that a lot of people think that they're contacting the listing agent, the agent who's listing
100%.
the property.
100%.
But that's not what's happening. When they say contact me for this property, they are contacting one of the agents. They're selling your information to. That is what's happening. And so, but at the end, Zillow has, you got to hand it to them. I mean, they dominate the market. They have done a bang up job of being the portal that people go to search for real estate. So I have never been really a hater, but this thing here, this right here,
it's disturbing.
This is disturbing. This is massive. And they my fear is that they're just going to get a slap on the wrist. That's my fear. I'm hoping not, because they need to. This has to. There has to be a message has to be sent to them that this is just not okay. This is a real freaking violation. And for the longest time, Zillow didn't want to get into the brokerage business because they didn't want all the liability. This is why. Well, this is precisely why.
That would have been a smart move for them probably at this point to not get into that. But. Yeah. But yeah, that's the problem. There's so much money, whether it's the real estate part, the title part, the lending part. There's so much. So they're trying to encompass the whole thing. And,
sure.
So.
Yeah.
But I guess there's probably a few other changes going on, and nothing stays the same, right? I mean, the stuff we're talking about with, the changes in the mortgage business to create mobility or to get things moving again, or the lawsuits.
There's always something in real estate. There's always something changing. There's always something happening. You always have to stay on your toes and stay current. So
yeah. Well, we got Fannie Mae doing away with their minimum 620 credit
I
score.
heard that. Tell me, what is that?
Not a lot of nothing. They had a minimum credit score. They just basically kind of removed that. We do the same thing we do as far as qualifying. We just So
they removed the minimum credit score, which used to be 620.
Yeah, and so this is a whole lot of nothing really in the respect of somebody's got, a 620 or 605 credit score. We're going FHA anyway. We're not even considered, going that other route.
Right.
Yeah. So.
Okay.
Yeah, it's just really
But there's always something.
Yeah. There's always some change, and that's 90% of it stays the same, and you got this 10% that's always kind of evolving. You got to stay on top of. So
right.
New conforming loan amounts too.
So what are they now?
So I think it went up about $20,000. I think we were around a little over 806,000 for the DMV, and I think we're like at 825. So
825.
Yeah, which is a good thing. I mean, it helps people. I mean, when you stay at the conforming level, that means you're not hitting jumbo, what they call jumbo, and jumbo carries a higher rate, right? Yeah, high balance.
So the benefit is that you get a lower rate.
Yeah, and the other benefit for people that are out there listening that bought a house that's an expensive mortgage that want to refinance from from a higher rate, if you're rolling in some of these fixed costs, it allows you to roll in more.
Okay.
Because you're still staying below that limit. So there's, I mean, it's definitely every little bit helps, especially.
For sure.
The pressure that people are under with the high costs, the higher interest rates, getting that, the prices aren't coming down. But if we can get the interest rates down to a more
manageable.
Yeah, and people say, they have this thing all the time where they say, when I got into business or in the 80s, the rates were 16%.
18, 20%.
Yeah, look at 16% interest rate on a $850,000 house and tell me if that payment seems doable.
So, not very many people are going to be able to buy a home.
So that's the difference. You can say it all you want, but
yeah.
Man, thanks for having me again, man. I really appreciate it.
Thank you for always coming all the way here.
Hopefully I added some value.
You always do. You always do.
Yeah, well.
So again, man, thank you for always coming here, making the time, and to drive here and chat with me. And let's do it again soon.
Yeah, my pleasure. Thanks for inviting me.
Thank you for coming, guys, and thank you for tuning in. We'll see you at the next one.